and today we're diving into the latest on inflation in Canada. We've got some good news to share, especially if you've been feeling the pressure from rising prices over the past couple of years. Canada's inflation rate has taken a dip, which means some relief is on the way for your wallet. But there's a lot more to the story, so stick around because we'll break it all down from why prices are easing to what this could mean for your interest rate as well as housing affordability. Alright, let's kick things off with this latest numbers. In September 2024, Canada's inflation rate dropped 1.6%. That's down from 2% in August, and that marks the lowest inflation rate since February 2021. Now, this might seem like just a small decrease, but it's significant, for months of inflation has been running hot, well above the Bank of Canada's target rate of 2%. What makes this drop even more noteworthy is that economists were expecting inflation to sit around 1.9%. So we're actually seeing better than expected results. This is the second consecutive month inflation has been below the Bank of Canada's target, which is a big deal when it comes to how they manage interest rates, but we'll get to that a bit later. So what's behind this recent drop in inflation? Mainly due to a few key factors. Gasoline prices have been falling significantly, which is a relief for anyone who's been filling up their tank lately. In September 2024, gasoline prices dropped by 10.7% year over year. Just for comparison, in August, gas prices had already fallen by 5.1%. That means the price you pay at the pump is making a bigger difference in the overall inflation pictures. It also brings down transportation costs across the board, from shipping goods to air travel. Now let's talk about one of the biggest factors in inflation is housing, especially rent, have been sky high in many Canadian cities. In September, the rate of increase in rent prices slowed down a bit, dropping from 8.9% to August to 8.2% in September. So while rent is still rising, it's not climbing as fast as it was. This slight ease is a small victory, especially for renters who've been hit hard by rising housing costs. Another area where we saw prices fall is transportation. In September, transportation costs decreased by 1.5% compared to a tiny 0.1% decrease in August. Again, this ties back to the gasoline prices and the lower cost for transportation goods. It's important to keep in mind when transportation costs go down, it can have a ripple effect on the prices of all sorts of products, from groceries to clothing. While those three factors were the biggest drivers of low inflation, there are a few other noteworthy points from the data. Food prices haven't been so cooperative as other sectors. In September, food inflation went up slightly from 2.7% to 2.8%. It's a small increase, but every bit counts for your budgeting. For groceries, food prices are often influenced by the factors like weather, global supply chain issues, and agricultural conditions, so they can be a bit harder to control than the inflationary factors. Volatile items like food and energy stayed steady at 2.4% in September. This is a crucial metric because it gives a clearer picture of the underlying inflation trends, without the short-term noise created by fluctuations in volatile sectors. The fact that core inflation didn't budge shows that while inflation is coming down in some areas, there are still underlying pressures that haven't fully eased up. On a month-to-month basis, Canadian consumer prices fell by 0.4% in September. This is another sign that inflationary pressures are easing, at least in the short term. But remember, month-to-month changes can be volatile, so we'll need to see if this trend holds in the month to come. Now let's get into one of the biggest questions on everyone's mind. What does this mean for the interest rates? Well, when inflation is high, central banks like the Bank of Canada to raise interest rates to cool down the economy. The higher the interest rates make borrowing more expensive, which slows down the spending and investment. Over the past 2 years, the Bank of Canada has aggressively raised interest rates in response to soaring inflation. These hikes have made mortgages, car loans, and credit card debt more expensive, which has been tough for many Canadians to deal with. But with inflation falling, below target rate of 2%, the Bank of Canada may finally hit the pause button for further interest rate increases. This is especially good for news for homeowners variable rate mortgages, as their monthly payments could stabilize or even decrease if the Bank of Canada decides to lower rates. Businesses looking into borrowing money for expansion or investment could also benefit from a more stable interest rate environment. However, the Bank of Canada is likely to remain cautious. Even though inflation is below target right now, it's only been 2 months. And as we've seen with food prices and core inflation, some areas of the economy are still facing upward pressure on prices. The central bank will probably wait for more consistent data before making any big moves on interest rates. So, what does this all mean for you, the consumer? First and foremost, lower inflation means your dollar goes a little further. Over the past year or so, rising inflation has chipped away at purchasing power, making everyday items like groceries, gas, and housing more expensive. With inflation easing, some of the pressure is starting. If you're a driver, you probably already noticed the relief at the pump with falling gas prices. And if you're a renter, you might find that the rent increase aren't as steep as they were earlier this year, though they're still high. Overall, the drop of inflation gives households a bit more breathing room, especially when it comes to essentials like transportation and energy. That said, food prices are still on the rise, while means grocery shopping is still a challenge for many Canadians. Plus, while rent increases have slowed, housing costs remain elevated in many cities, and that's a big burden on families trying to make ends meet. What can be expected in the months to come? While September's data is promising, there are still several factors that could influence inflation moving forward. Gasoline prices played a huge role in bringing down inflation, but energy markets are notorious for volatility. Any disruption in global oil supplies or geopolitical tensions could send gas prices right back up, which could put renewed pressure on inflation. This is something to keep an eye on as we move through the fall and winter months. Although rent growth has slowed, housing affordability remains a significant issue in Canada. Prices are still high, especially in the cities like Toronto, Vancouver, and Calgary. If housing costs continue to rise, they could offset some of the progress made by lower inflation in other sectors. Policymakers will need to address housing supply and affordability issues if they want to keep inflation in check over the long term. Inflation continues to be a concern. It's one of the more unpredictable elements of inflation. It's subject to factors like agricultural yields, weather conditions, and global trade. A continued rise in food prices could put a strain on household budgets, and particularly for low-income Canadians. One thing to watch is wage growth. As inflation comes down, there's usually pressure for wages to increase to catch up the cost of living. If wages rises too quickly, it could fuel inflationary pressure in this service sector, leading to wage price spiral. Balancing wage growth with inflation control will be a key challenge for policymakers. In conclusion, Canada's inflation rate hitting 1.6 in September is a step in the right direction. We're seeing relief in the key areas like gasoline, transportation, and shelter costs. However, changes remain, especially in the food prices and housing affordability. The good news is that with inflation below the Bank of Canada's target, there's a less pressure to raise interest rates, which could bring relief to borrowers across the country. But as always, we need to stay vigilant. Inflation is a complex issue, influenced by the global events, domestic policies, and economic trends. We'll be watching closely to see these positive trends continue in the rest of 2024 and beyond. As always, I'll keep you updated on the latest insights, so be sure to hit that like button and subscribe to my channel for more real estate economic news. And please leave a comment and let's keep the conversation going.